If you're a high earner and you have the option of contributing to a deferred comp plan through work, then this episode is for you, and I think you're going to find it extremely helpful. Because over the next few minutes, what we're going to do is we're going to break down what a deferred comp plan is, how it compares to other retirement savings options, and then some key considerations you need to know so that you can use your deferred comp plan to supercharge your retirement. This is another episode of Ready for Retirement. I'm your host, James Connell, and I'm here to teach you how to get the most out of life with your money. And now, on to the episode. There's lots to break down today, and I'm excited for this episode because you don't typically see a ton of good information on how to make the most of your deferred comp plan. So let's jump in, but before we do, I want to quickly highlight the review of the week. This comes from username Thinking Listener, 5-star review, and Thinking Listener says, if you want to know more, learn key underlying details of financial planning concepts, this is a great podcast. No empty noise or opinions, just mostly lots of useful facts in a clear presentation style filled with useful situation examples. Thank you very much for that review. I appreciate those of you who have taken the time to do that. More and more people are finding this podcast every month, and it's great to see the feedback from people saying how much it's impacted their ability to plan for their retirement. So if you're listening, if you've enjoyed this podcast, if this has contributed in any meaningful way to your ability to plan for your retirement or just overall financial situation, I would appreciate if you took a few moments to click the 5 stars if you're on Apple Podcasts or Spotify. And if you're on Apple Podcasts, leave a written review as well so more people can find the show. And again, thank you to all of you who've already taken the time to do so. So let's jump in, and I'm excited to be back this week. I hope you enjoyed the last 3 episodes. They were hosted by Ari Taubleib, who's the vice president at Root Financial, and he is the host of the Early Retirement Podcast. So if you don't already do so, make sure you're subscribed and tuned into his podcast as well. Tons of great information and wisdom there too. So again, that's the Early Retirement Podcast. Check that one out as well. I'm back now going forward, and today we're going to be talking about deferred compensation. So to start, what is deferred compensation? Well, it's exactly what it sounds like. You receive compensation when you have a job, you have an income, you have a salary, but you choose to defer that compensation until a later date. So deferred compensation. Now, there are 2 types of deferred compensation. There is qualified deferred comp, and this is typically what you have if you have a 401k plan. You're deferring some of your compensation to the 401k plan that you will then withdraw at a later date. And there's non-qualified deferred compensation plans. Today, we're mostly going to be talking about the latter, because typically when you hear someone talk about having deferred comp, it's usually the non-qualified variety that they're referring to, and there's a lot less information or planning guidance that people have around non-qualified deferred comp. So that's what we're going to be spending our time on today. It is important to note, though, the key differences between what makes a deferred comp plan qualified versus what makes a deferred comp plan non-qualified. Well, a qualified deferred comp plan, these again are typically things like your 401ks, they are protected by something called the Employee Retirement Income Security Act. You might see it referred to as ERISA, E-R-I-S-A. And with ERISA, there's lots of rules, and these rules are designed to plan or to protect plan participants. So for most people, their 401k is their primary retirement asset. The ERISA, the rules of ERISA are designed to protect that. So ERISA, it's a federal law, and what it does is it's implementing standards for certain employer-sponsored retirement plans, aka 401ks, and regulations for plan fiduciaries. And what it does is it prohibits fiduciaries from misusing funds. It sets minimum standards for things like participation or vesting or benefit accrual and the funding of these retirement plans. So with ERISA-sponsored plans, they are designed to be broadly available to all, if not most, employees meeting certain conditions. There's rules against discrimination testing. So, you can't have what are considered highly compensated employees getting to contribute a bunch to these plans, while non-highly compensated employees are being excluded. And there's really, at the end of the day, all kinds of protections in place to make sure these plans are protected because, again, for most people, this is their primary retirement asset. Now, non-qualified deferred comp plans, these are not protected by ERISA. So pros and cons to that. Now, one of the requirements of qualified deferred comp plans, as I mentioned, is broad coverage. You can't only offer it to highest paid employees or to people meeting certain conditions. Well, with non-qualified deferred comp plan, you can. Non-qualified deferred comp plans, they're typically designed for corporate executives. So they're typically designed for more highly compensated employees, and they allow them to defer a much larger portion of their compensation, which allows taxes to be pushed way back until that compensation is actually received. So today, the way that we're going to break this down is the goal is to understand how does a non-qualified deferred comp plan work, what are the key benefits and what are the key downsides, and then most importantly, how can you best use it in your situation. The way we're going to do that though is I'm going to compare and contrast it to a qualified deferred comp plan. And just to keep things super simple, because I know it's probably already a little confusing to say, okay, did he say that was a qualified deferred comp plan or non-qualified deferred comp plan? Well, going forward, I'm going to simplify it and I'm going to call the non-qualified deferred comp simply deferred comp, and I'm going to call qualified deferred comp a 401k. Now, that's not precisely accurate, but I think it's just going to help as we understand what's what. So a non-qualified deferred comp, I'm just going to refer to that as deferred comp going forward. But to start, let's understand why you would even consider deferred comp as opposed to just using your 401k, and let's look at an example like we typically do to illustrate this. Let's assume you have two individuals, and both of them have determined through working with their financial advisor or laying out their financial plan or whatever it is, they've determined they need to save 15% to retirement to be on track for their retirement goals. Now, the first individual, let's assume their salary is $100,000. Well, they need to save 15% of that. That comes out to $15,000. This individual could easily save all that to their 401k. No need to do anything else. Well, the second individual, let's assume their income is $500,000. Well, the max you can put into your 401k, and this is if you're 50 or older, is $30,000 per year. So for this individual who's trying to save 15% to retirement to maintain their lifestyle, only 6% of their income is actually going into their 401k, and then they're capped. So the question is, what do they do next? All kinds of options, but if they want to keep saving and be on track to maintain their lifestyle for retirement, they need to put money away somewhere else as well, and a deferred comp plan might just be the place to do that. So that's typically where you want to start. If you've already maxed out your 401k, then you might consider deferred comp plan, but only if you're eligible for it, because not everyone's eligible for it and not all companies even offer it. Now, quick note here real quick before we go on is there are certain government deferred comp plans that are subject to a different set of rules. So if you're listening to this, you might be a firefighter, you might be in law enforcement and saying, wait a minute, I have a deferred comp plan. Well, you do. They're subject to a different set of rules, and in many ways, they act more like a qualified deferred comp plan, so more like a 401k in many ways than they do a non-qualified deferred comp plan. So just a heads up as we're going through this, make sure to check with your financial advisor, make sure you check with your CPA, make sure you do some good planning before you actually see how do you implement this into your overall financial strategy. But let's start to compare and contrast the differences between a 401k plan and a deferred comp plan. Number one, the first main difference is the contribution limits. So if you have a 401k, if you're 50 or older, you can contribute for 2023 $30,000 as what's called an elective deferral to your 401k. If you're under the age of 50, your limit's $22,500. So that's a pretty high contribution limit, but again, it's all relative and it's all based upon your income. That's probably enough for someone who's making $100,000, $120,000, $150,000 even. But if you're making $500,000, $600,000, $700,000 and you're trying to put away a percentage of your income, you're probably going to more than max out your 401k and still be wanting to put some more money away. Well, a deferred comp plan, there are no IRS imposed limits. Now, a lot of plans will have limits. They might say you're eligible to contribute up to, say, 50% or 70% or some number to your deferred comp plan, but the IRS does not impose any limits upon how much money you can put into a deferred comp plan. So that's one of the biggest differences there. Another difference is eligibility. As I mentioned with this thing called ERISA, if you have a 401k, it has to cover all employees, or at least all employees that work, say, a minimum number of hours or have been with a company for a certain period of time. But the goal of a 401k is the Department of Labor saying we need retirement savings to be within reach of everyone, not just highly compensated employees. So typically, a 401k has broad coverage where it's offered to most, if not all, employees. If there's any type of a matching contribution, that is available to most, or if not all, employees. Versus a deferred comp plan, it's typically only offered to executives. It's not offered to everyone. And now some people say, well, that's not fair, and why isn't it offered to everyone? Which, sure, you can absolutely look at that, but as I mentioned before, most people who aren't earning a pretty extraordinary income, a deferred comp plan's not really necessary. You can get all the benefits or most of the benefits and even then some through a 401k. And it's not really until you've maxed your 401k that anyone would even consider a deferred comp plan in most cases. But do understand that not everyone is eligible for a deferred comp plan. First, the company has to offer it. And then number two, you must be a member of the company that's eligible to participate in the deferred comp plan. The third difference is in matching contributions. So with a 401k, it's not required, but a lot of 401k plans will offer matching contributions. So for example, if you contribute 3% of your salary to the 401k, the company will match 3% of your salary. Or maybe if you contribute 6, they'll match 3. There's some formula for if you put money in, the company is making some matching contributions on your behalf. Typically, with a deferred comp plan, it's only your deferrals. So if you're making, say, $400,000 a year and you want to defer 20% of your salary to deferred comp, well, you're putting $80,000 per year into deferred comp. There's not really matching contributions on top of that. So the benefit is not like a 401k where it's leaving free money on the table if you don't contribute to it. A deferred comp is almost purely a tax play where you're trying to defer the compensation you're receiving today to push that out to a later time where you'll be taxed on it when you leave the company or at whatever the triggering event might be. So matching contributions are a key distinction between 401ks and deferred comp plans. The next big difference is the risk aspect of it. So with a 401k, as I've mentioned a couple times now, it's protected by ERISA. So the funds that you set aside, the key thing I want you to realize is the funds you set aside into a 401k plan, they're not subject to the general creditors of your company. So let's assume you're working for a company that's not managed very well. Well, you put money into your 401k and the company goes under, those 401k assets are still your 401k assets. In the news recently, I'm recording this literally the Monday after Silicon Valley Bank went under. Well, for employees of Silicon Valley Bank, if they have a 401k with the company, their 401k is safe. That is their funds that are earmarked in a separate account that's set aside for them. It's almost like having a lockbox within the company's 401k plan. You just now go move that lockbox to a new company 401k or to a traditional IRA. Well, deferred comp is much different. One of the key things of deferred comp is it's unfunded and it's subject to the general creditors of the company. What does that mean? Well, unfunded means that assets haven't been set aside by your employer to actually pay plan benefits. So this is one of the interesting things about deferred comp is if you defer 50 grand, 100 grand, whatever it is, you have a statement showing you, hey, James, here's the money that you've deferred. Here's what you've invested in. Here's if that investment has gone up and down in value, the same way that you'd have a statement for a 401k or any other investment account. The thing, though, is those dollars aren't actually there. They're there from an accounting standpoint, so the company understands what's owed to you when you get paid out, when you leave the company or whatever the triggering event is. But those assets aren't actually there from the sense that they're not separately set aside. They're just part of the company's general assets, where there's a liability on the company's books saying, hey, this is something that has to be paid out in the future, but it's not set aside for safekeeping in the same way a 401k is. So let's go back to that example of Silicon Valley Bank. As I mentioned, employees who had 401ks there that were protected by ERISA, those funds were set aside, those funds are protected, those funds are the employees. If there was a deferred compensation program with Silicon Valley Bank that was for the executives, for people higher up, well, those assets, those weren't actually there. They're not in almost like a separate lockbox. Those assets were assets of the company as a whole. The company as a whole went under, which means there are now no more deferred comp assets to be paid out. So if you're an executive there and you've put away hundreds of thousands of dollars, if not millions of dollars, it's conceivable that you just lost all of that with a company going under. So that is one of the key things that you have to be aware of with deferred comp is it's not like another investment account where those assets are yours. Those companies are essentially IOUs. And if the company is solvent and has assets and can pay those IOUs, you're in good shape. The company's not solvent or can't make those payments, you're out of luck. You've lost a lot of money with that money going under. So anytime you make the decision to elect a deferred compensation arrangement with your company, looking at the health of your company is absolutely an important component of what you're doing. If your company isn't in great shape, you might want to stay away from the deferred comp plan. But recognize that sometimes this is really hard to tell. A year ago, you'd have looked at Silicon Valley Bank and said, wow, this company's in great shape. even months ago, weeks ago, you'd have looked at it and said, wow, this company's in great shape. Now, the uniqueness of this being a bank and how quickly things can turn with certain things going on has some unique provisions, but fully understand. Risk is inherent to every single company, and risk is inherent to investing in a deferred comp plan. So make sure that's an important part of your analysis when deciding what to do with yours. The next thing to consider is with a deferred comp plan, you have investment options. Now, this is very similar to a 401k. And in fact, a lot of companies, if they do offer a deferred comp plan, the investment options they have within the deferred comp plan are very similar, if not the same, to the investment options they have in the 401k. So they both have a menu of investment options that you can choose from. Now, you may be saying, James, wait a minute. I thought you said the funds weren't actually set aside. It's just for accounting purposes. Well, you're right. The funds that you're deferring, so again, if I defer $50,000 per year to do a deferred comp plan, I have a statement that shows this is what I deferred, but those funds aren't actually there. That statement is for record keeping and accounting to show, okay, when I do leave, here's what's owed to me. So when I'm investing, quote unquote, investing the funds I have, I'm not actually investing in the funds, which I know is odd, but I am getting credited with the investment performance of those funds against the amount that I deferred. So if I defer money, and same way as a 401k, if the fund is up, well, I now have more money that the company owes to me. If I defer money and the fund I choose to invest in is down, or the mix of funds I choose to invest in is down, well, then there's less money that the company owes to me. So the investment options typically are similar, if not the same, but it is unique just to know that with a 401k, those are actually your assets in a separate set-aside account. With a deferred comp plan, you'll see a statement that shows the assets you're invested in, but recognize money hasn't actually been set aside for you as much as they're using that as a way to keep track of what is owed to you. So now let's talk about payment options. This is an area where it's very different between a 401k and a deferred comp plan. With a 401k, there's a lot of flexibility. If you leave a company, you roll your 401k over to your new company's 401k, or you roll it to an IRA, and then you have full control of taking distributions when you want. Obviously subject to required distribution ages when you're going to be forced to start taking distributions. But in general, you have full control over that, of the timing of when you take distributions. With a deferred comp plan, things are very different, and you end up withdrawing the money at an agreed upon date. So before you elect to put money into a deferred comp plan, you're going to have to elect how you receive that payout. And this could be triggered based upon retirement. It could be triggered based upon leaving a job. It could be triggered by something different. But you are going to have to either elect a lump sum option or installment distributions. So for example, if I go work for a company that offers a deferred comp plan to me, they're going to say, James, you need to make an election. We're going to pay this money out to you when you retire. You can either receive it, for example, as a lump sum all the year after you retire. You can receive it over 5 years in equal annual installments, or you can receive it over 10 years. Now, let's assume I've been with the company for a while and I've put away $1 million into this deferred comp plan. Well, if I choose a lump sum option, that $1 million, it's not like a 401k that can roll over to an IRA. It's paid to me. So all that $1 million gets paid to me and is taxable to me all in one single year. Versus if I had done a 5-year installment or 10-year installment, then that money's spread out over 5 years or 10 years, where I still can't roll it to an IRA, but it can be spread out over some time. Now, one important thing to note is as you're looking at this, there's some important tax benefits at the state level to be aware of. And the tax thing that you need to be aware of is this, is typically the deferred comp payout is subject to taxes in the state that it was accrued. So if I'm in California, for example, and let's assume, okay, I'm making $1 million this year, I want to defer $500,000 to deferred comp because I'm going to move to Texas next year when I retire and there's no state income taxes. So I'd look at that and say, okay, awesome. $500,000 goes into deferred comp. Let's assume that ends up saving me $60,000 in taxes. And I should clarify that $60,000 in taxes just at the state level, at the California level. It would also save me quite a bit in federal taxes, but I want to focus on the state tax piece because I'm saying, okay, I make $1 million, I defer $500,000 this year, then I'm going to move to Texas at the end of this year when I retire, and I'm going to take that $500,000 out as a lump sum there. Well, I would do that because it seems to me like that's a great way to avoid the state tax piece. Instead of earning that $500,000 in California, I'm going to be in Texas when I receive it. So I'll save all of the state income tax piece. except that's not quite how deferred comp plans work. If you earn that money in California and then move to Texas or Florida, really any state, and you take the distribution as a lump sum, then it's taxable still at the California level. However, the exception to this is if you take the income in 10-year installments, then there's a special rule where you pay state taxes in the state in which you're living. So if I did that same thing, if I put $500,000 into a deferred comp plan here in California, then I moved to Texas and elected to receive that $500,000 over the next 10 years, now state taxes is due based upon the state that I live in, not the state that it was earned in. So that's a very important piece for those people who are playing around deferred comp is where are you? What state are you in when you deferred that money? And what state do you intend to be in when you receive that money? That could have a pretty dramatic impact on what election do you choose, whether it's lump sum, 10-year installments, or anything else. So a couple other key points, then I want to quickly dive into how do you best use this to leverage what your retirement plan looks like. And the first is around early withdrawal penalties and RMDs. So with the 401k, if you withdraw that money before 59 and a half, there's a 10% penalty. Now there's an exception if you retire after 55, but in general, there's a 10% penalty if you withdraw money early, and you will have a required minimum distribution starting anywhere between age 73 and age 75, depending on how old you are. With a deferred comp plan, there is no 10% early withdrawal penalty, and there is no required minimum distribution. So just an understanding of how that might fit into your overall plan. And then another difference is around how you elect to contribute. So the 401k, you can typically change how much you want to contribute whenever. Are you going through a cash crunch? Okay, maybe you reduce your 401k temporarily. Maybe you have excess income? Well, great, go increase your 401k. It's very flexible. You can change it pretty much at any time. Well, with deferred comp, you have to make an election typically for the entirety of the year. So they'll typically say you can contribute anywhere between, and I'm making numbers up, 1% and 50% of your income to our company's deferred comp plan, but you have to choose a number, and that number is in effect for the next year. So if I say, hey, I want to do 50% because I want to defer a bunch of money in taxes, and then I run into a cash crunch, or then I run into an emergency, I need to be aware of that because I cannot change my deferred comp elections. What has been made, and it's not until the next year when you enroll again that you can make any changes. So that was just a rundown of some key differences and similarities between 401ks and deferred comp plans. Now I want to touch upon how do you use it most effectively. So this isn't just an informational thing, but this is going to give you some context about how do you fit this within your plan. Well, number one, how do you use a deferred comp plan most effectively? You need to make sure you're implementing an investment strategy that complements your other assets, including other retirement accounts like 401ks or IRAs, and it also works within the unique limitations that are imposed by the deferred comp investing rules. So what do I mean by this? Well, when you are looking at retirement, let's assume you've got some money in deferred comp, some money in a traditional IRA, some money in a Roth IRA, and some money in brokerage. Well, that's pretty overwhelming. Should I be invested the same way in all of them? Well, not necessarily. Let's assume that your deferred comp has a 5-year payout. Well, what that tells me is you have to take money from your deferred comp plan over the next 5 years. The first thing I'd look at is how much is that projected to be? Now, if we look at how much that's projected to be, and you say, oh, that amount is going to fully cover my living expenses for the next 5 years, well, great. That means we can treat our IRAs, our Roth IRAs, our brokerage assets for years 6 and beyond because we're going to be forced to spend down our deferred comp plan those first 5 years. So let's maybe allocate that a little bit more conservatively. Let's treat that as a conservative bucket of our portfolio because of the time horizon that we're going to need to draw that money down from. What that does is it says even if I'm retiring today, I have at least 5 years where I don't have to touch my other investment assets. So as I'm putting together an asset allocation for those assets, I can start to understand they don't need to be available for today. It's more important that I get some growth on these assets so I can use them in future years. So that's just a very simple explanation and overview, but as you're looking at this, make sure you have a game plan for how your deferred comp plan is going to be invested based upon where you're going to be withdrawing it and how it's going to be used in your portfolio. And then how does that impact how other accounts should be invested? The second thing that you really want to make sure you're doing analysis on is really strongly consider whether the lump sum option is right for you, because in many cases, it's not. Now, it's not a horrible thing if you end up getting money as a lump sum, but oftentimes with some good planning up front, some good proactive planning well ahead of the time that you're actually going to be taking out money from your deferred comp plan, you can do something that's going to be more effective from a tax standpoint to you. Because if you take the lump sum option, you might end up paying as much or even more than you saved in taxes by doing the deferred comp plan when you receive that lump sum out. For example, maybe your income's $350,000 per year and you end up deferring $50,000 per year for 10 years. Well, what that does is instead of being taxed on $350,000, now you're only taxed on $300,000. So that's great. That probably saved you, if you're married filing jointly, maybe 24% federal taxes by deferring that $50,000 per year. Well, maybe you do this for 10 years. You've put away $500,000 collectively over those 10 years, so $50,000 per year times 10 years. Let's assume there's a little bit of growth. So now your deferred comp balance is at $650,000. Well, each year you did that, you saved taxes at a 24% rate at the federal side. Well, if you elected the lump sum option, and all this is now coming out as a lump sum when you retire, well, that's $650,000. And if that's stacked on top of any other income, that's going to easily push you into the 35 or 37% tax bracket, depending on other income sources. So you saved 24% in taxes for putting money in, but you paid 35 to 37% taxes, using today's brackets, on the way out. That ended up hurting you by electing the lump sum option. So if you can spread that out, whether it's 5 years or 10 years, and again, this should be part of an overall strategy, but just understand that sometimes that lump sum option isn't actually helping you as much as it would have if you spread the money out a little bit more. Another thing to be aware of if you want to use these plans most effectively is really understand the triggers for at what point will this plan be paid out. A lot of times it's when you leave the company. Well, that might be fine if the time that you leave the company also corresponds to your retirement, but what if you're a high income earner and you're not going to be at this company from now until you retire? So for example, I have a few relatively young clients that have options to invest in a deferred comp plan, and they're very much in the highest income tax bracket. Well, these clients are not going to stay at their company forever. So they ask, should I use this deferred comp program? And we look at it and we say, yeah, if you put money in here, it could save you 37% on the dollar at the federal level for what you put in, but let's play that out. That seems good today, but what happens in 5 years, for example, when you leave this job for another job where you're paid even more money? Well, you're paid even more money, which means you're still in the highest income tax bracket, and now this deferred comp balance is getting paid out to you on top of that. It's not really actually saving you any money in taxes. It's just kicking the tax can down the road. And keep in mind, after 2025, unless anything changes, current tax brackets are going up. So if you're going to be using a deferred comp plan, but you expect to roll over to another company or transition to another company with the same high income, is that deferred comp balance really going to be helping you by saving you any money in taxes? And the answer is probably not. You're kicking the tax can down the road, which would be fine if you're kicking it down the road to when taxes will be lower. But if you're kicking it down the road to when you'll be in the same or higher tax bracket, and taxes as a whole may be higher, it might not be benefiting you. So have a holistic view of, if I'm going to elect to participate in this plan, where will I be using these assets? How will I be using these assets? Because the final consideration is just cash flow. All we've really done so far is talked about the financial pros and cons of a deferred comp plan, but really big picture, we need to look at, is it necessary? I have lots of clients that have deferred comp plans and we forgo using them because we look at their situation. We see between their current assets, between 401ks, between brokerage accounts, pensions, etc., they're already on track not to need deferred comp plan to still fully fund their retirement goals and then some. So we look at this and say, okay, do you have extra cash flow that you just couldn't possibly spend? If so, deferred comp plan is maybe a way to allocate those funds for the future. But if there are other things you could do with that cash flow today, well, then let's consider using that cash flow today. It's not all about tax efficiency and deferral and saving for the future. We have to balance future needs with current consumption to make sure that we're living a more balanced life when it comes to our finances. So I hope that was helpful. That's a little bit of a rundown between deferred comp, 401k plans. Hopefully you can use this information to more effectively use your deferred comp plan if it's available to you within your own retirement strategy. So thanks as always for listening, and I'll see you next time. Thank you for listening to another episode of the Ready for Retirement podcast. If you're looking to work with a financial advisor that cares deeply about helping you get the most out of life with your money, head over to our website at rootfinancialpartners.com and click Start Here. One of our advisors would love the opportunity to speak with you. You can also find the show notes for today's episode on our website, along with other great content that will help you to create a wonderful retirement. And finally, if you have a question that you'd like for me to answer in a future episode, then from our website, click on the Learn tab. Scroll down just a bit on that page and then click Submit a Question to submit a question that I will answer in a future episode. Again, that can all be found at rootfinancialpartners.com. Thanks as always for listening, and I'll see you next time. Hey everyone, it's me again for the disclaimer. Please be smart about this. Before doing anything, please be sure to consult with your tax planner or financial planner. Nothing in this podcast should be construed as investment, tax, legal, or other financial advice. It is for informational purposes only.